For 70 years, I've watched people systematically destroy their retirement savings, and the patterns literally never change. Decade after decade, the same mistakes come back like clockwork. People think safety comes from avoiding risk. They're dead wrong. Real safety doesn't come from running away from danger. It comes from deeply understanding exactly what you own, why you own it, and, most importantly, understanding how you yourself will react when fear or greed screams in your ear. Most retirees confuse comfort with safety. They want something that feels safe, not something that actually is safe. That's a colossal difference. A 3% CD while inflation runs at 5% feels calm and steady. The number barely moves. In reality, you're getting poorer in slow motion. That's not safety. That's suicide with a smile. Let me be crystal clear about one thing and carve this into stone. There is no such thing as a perfectly safe investment on this planet. Anyone who promises you otherwise is either ignorant or selling something, usually both. What exists are intelligent trade-offs. You can trade growth for stability. You can trade liquidity for yield. You can trade complexity for simplicity. But you can never have maximum safety, maximum return, and maximum liquidity at the same time. The financial universe simply doesn't allow it. When someone nearing retirement asks me, what are the safest investments? They're almost always asking the wrong question. They want me to name magic products. Products don't protect you. Thinking protects you. I could hand you the 3 greatest investments in the world for a retiree, and you could still blow everything if you panic at the worst moment or chase yield at the worst moment. The biggest risk in retirement isn't the market. It's you. Your emotions. Your impatience. Your pathological need to feel clever. That's what has sunk more portfolios than every recession combined. But if you can master yourself, if you can sit still while everyone else runs, if you can think clearly when fear is screaming from every screen, then 3 very simple, very boring, extremely resilient investments will carry you faithfully to the end of your days. They won't make you rich overnight. They will, however, keep you from dying poor. And in retirement, that's the only score that matters. Pillar number 1, Dividend Aristocrats, 40 to 50% of the portfolio. The first investment every rational retiree should own is so boring that most people can't stomach it. They want excitement. They want explosive growth. They want to feel like they're doing something. What they actually need is the financial equivalent of a regulated utility, steady, predictable, and still functioning when everything else is on fire. I'm talking about dividend-paying stocks from companies that have lived through every crisis you've ever seen and a few you haven't. Not just any dividend stocks. Only those that have raised their payout every single year for at least 25, 30, or even 50-plus consecutive years. In the U.S., we call them Dividend Aristocrats, 25-plus years, or Dividend Kings, 50-plus years. These companies represent something most of today's investors have completely forgotten: iron discipline. These firms don't just pay dividends when times are good. They raise them when times are bad. In 2008, while Lehman Brothers was collapsing and the world was screaming that capitalism was dead, Coca-Cola, Procter & Gamble, Johnson & Johnson, 3M, and Colgate-Palmolive quietly raised their dividends again. Not out of generosity, because they could, because they had built economic fortresses that generate cash in almost any environment imaginable. That's exactly what a retiree needs. Cash flow that doesn't stop just because the headlines turn terrifying. Most people think safety means very little price movement. That's completely backward. Real safety is income stability. I don't care if Coca-Cola's stock price falls 30% in a year. I care whether the dividend check still shows up every quarter. And it will. People don't suddenly stop drinking Coke, brushing their teeth, or doing laundry in a recession. Those habits are hardwired into human behavior across generations. Human behavior is infinitely more stable than stock prices. When you own Dividend Aristocrats, you're not betting on the next revolutionary technology. You're betting on something far more reliable: human nature. People will keep buying toothpaste, shampoo, diapers, cereal, soda, ketchup, and painkillers for the next 100 years, no matter who's in office or what the central bank does. And the absolute beauty is that these dividends solve two massive problems at once. They give you income without forcing you to sell shares. In retirement, selling shares in a crash locks in permanent losses. If you live off dividends, you never have to sell. You just wait for sanity to return. They anchor you psychologically. When everything is collapsing and your neighbors are losing their minds, it is infinitely easier to stay calm when fresh cash keeps hitting your account every 90 days. You're no longer watching a number go down. You're receiving money. That tiny psychological difference separates winners from losers. People always say, but dividends aren't guaranteed. A company can cut them. Technically true. But a company that has raised its dividend for 30 to 50 straight years does not cut it lightly. It would be reputational suicide. For these firms, dividend reliability is part of their DNA. Johnson & Johnson has raised its dividend every year since 1963, through Vietnam, stagflation, 1987, the dot-com bust, 2008, COVID. If you had owned that stock in retirement, you would have collected rising income through every disaster of the last 62 years without losing a single night's sleep. Compare that to someone who went all in on the tech darlings of the early 2000s or crypto in 2021. They might have gotten rich, or they might have blown up. In retirement, you no longer have 20 years to recover. One explosion and it's over. That's why boring wins. Not because it's sexy, because it's survivable. I've said for decades that the best portfolio is the one that lets you sleep soundly. Dividend Aristocrats do exactly that. Their price will drop in bear markets, guaranteed. But the income keeps coming. And income pays your grocery bill, not the stock price. If I were building a retirement portfolio from scratch, I would always start here. 40 to 50% in a highly diversified basket of Dividend Aristocrats. Not one or two names. At least 12 to 20 across different sectors. Consumer staples, healthcare, industrials, utilities. Companies that make or sell things people need, even when they're pessimistic, not just when they're euphoric. This isn't a portfolio to get rich. It's a portfolio to stay rich. And staying rich is infinitely harder than getting rich. Another thing almost nobody ever mentions: growing dividends are a built-in inflation-fighting machine. Buy a stock yielding 3% today that raises its dividends 6 to 8% a year on average, and in 10 years you're collecting 6% on your original cost. In 20 years, 12%. Your income grows faster than inflation, while a bond you bought in 2000 still pays the same 4% nominal, which is less and less in real purchasing power. That's why I've always preferred quality stocks over bonds for retirees. Yes, stocks are more volatile, but volatility is not risk. Real risk is permanent loss of capital or permanent loss of purchasing power. On both counts, Dividend Aristocrats crush the competition over the long run. Pillar number 2, broad market index funds, 30 to 40% of the portfolio. The second investment is even simpler than the first, which is precisely why almost nobody executes it properly. People hate simplicity in finance. They think if it's simple, it can't be good. Dead wrong. I'm talking about index funds that own the entire market. S&P 500, total stock market, MSCI World, doesn't matter. One fund, thousands of companies. Zero stock picking. Most retirees should never try to pick individual stocks. That's not an insult. It's arithmetic. Even most professionals get beaten by indexes. And you're competing against quantum computers, high-frequency algorithms, and armies of analysts paid millions. Good luck. But there is one thing you can do better than any Wall Street genius. Own the whole haystack. When you buy a broad index fund, you're not betting on one CEO's brilliance or one sector's momentum. You're betting on a historical truth written in stone. Human beings, in aggregate, will keep getting up every morning trying to create value. That bet has worked for centuries. It will work for the next century too. From 1928 to today, the S&P 500 has delivered roughly 10% annualized, crashes included. Not every year, obviously. There were minus 50%, minus 37%, and decade-long flat periods. But over 20 to 30-year horizons, the curve is relentlessly upward. Compounding does the rest. Warren and I have been saying it until we're blue in the face. The average investor would be vastly wealthier simply buying a low-cost index fund and never touching it again. No trading. No market timing. No listening to economic forecasts, which are almost always wrong. Just buy and forget. The problem? People can't stand doing nothing. They need to do something. So they trade, switch funds, chase last year's winner, and systematically destroy their returns. The data is brutal. The average investor underperforms the market by 4 to 6% a year simply because they can't sit still. An index fund solves that problem by making activity pointless. There's nothing to tinker with. The fund rebalances itself. You just own global capitalism. And global capitalism, despite its periodic panic attacks, always wins in the end. In a retirement portfolio, I typically allocate 30 to 40% to a total market index fund with rock-bottom fees, under 0.1%. This slice isn't there to pay next week's groceries. It's there to grow your capital over 20 to 30 years so your kids or grandkids inherit something meaningful, or so you have an inflation-adjusted cushion when you're 85 to 90. With the first two pillars, dividends plus broad index, you already have a rock-solid structure, steady and growing income plus long-term growth. But you're still missing the keystone that keeps everything standing when the storm hits. Pillar number 3, cash and cash equivalents, 20 to 30% of the portfolio. The third investment is the one almost every retiree hates with a passion because it doesn't look like an investment at all. It pays almost nothing. It doesn't grow. It actually loses purchasing power to inflation. And yet without it, the first two pillars can collapse. I'm talking about cash, not cash under the mattress. Real cash equivalents, short-term treasuries, government money market funds, anything you can turn into spending money in 24 hours without losing sleep. People despise the idea of money sitting idle. They calculate opportunity cost like it's a mortal sin. They watch the market climb and feel stupid. That's exactly backward. Cash isn't dead money. It is life insurance for your portfolio. It's your parachute. It's your margin of safety against the single biggest mistake 90% of retirees make, being forced to sell assets at the worst possible moment. Picture this scenario. I've seen it hundreds of times. Someone retires in 2007 with $1 million, 100% in stocks. 2008 hits. Portfolio down 45%. They need $40,000 a year to live. They have to sell at minus 45%. They lock in the loss. Market takes 5 years to recover. They run out of money. Game over. Now picture the same person with 25% in cash equivalents, $250,000. 2008 hits. They live off cash for 3 full years. They sell nothing. Their stocks quietly recover. By 2013, they're whole, or even ahead. Who won? The person who looked dumb in 2007 holding cash, or the person who wanted to be fully invested? I've watched this movie in 1973 to 74 1987, 2000 to 2002, 2008, 2020, 2022. Every single time, the people with cash survived. The others bled. Cash gives you something no return can ever buy: time and freedom. Time to wait for the panic to pass. Freedom to never be forced to act. How much? Simple rule: 2 to 5 years of living expenses, depending on your anxiety level. Spend $50,000 a year. Keep $100,000 to $250,000 in cash equivalents. Yes, it feels like a fortune sitting there. That's the point. You want to be able to ride out a 5-year bear market without touching your stocks. Period. Cash also protects you from yourself. It stops you from panicking. It stops you from succumbing to euphoria and going all in when everything is flying. It gives you the ability to help your kids or grandkids in an emergency without blowing up your plan. And above all, it gives you peace of mind, the true luxury of retirement, the portfolio that lasts 30+ years. Here's the allocation I recommend to almost every retiree I advise. 40 to 50% Dividend Aristocrats, stable and growing income. 30 to 40% Total Market Index Fund, long-term growth. 20 to 30% cash equivalents, sleep well at night money plus crash parachute. You rebalance once a year, no more. You spend cash first, then dividends. When cash gets low, you sell whichever bucket has grown the most, never in the middle of a crash. You never sell stocks when they're getting slaughtered. Ever. This portfolio won't make you a millionaire in 5 years, but it has an overwhelming probability of keeping you comfortable until 95 or 100, no matter what the market, inflation, or politicians throw at you. The hardest part? Sitting on your hands while everyone else appears to get rich on crypto, meme stocks, or options. The hardest part is accepting being boring. But boring, compounded over 30 years, beats exciting 99 times out of 100. True safety in retirement isn't a product. It isn't a clever strategy. It's a discipline. It's the ability not to self-destruct. The 3 investments I just described are only tools. They work only if you let them work. So the real question isn't, what should I own? The real question is, can you sit still long enough for it to work? Most people answer no. Don't be most people. Be boring. Be patient. Be rational. And you will die wealthy. Not necessarily billionaire wealthy, but wealthy in freedom, wealthy in peace of mind, and wealthy in the certainty that you will never be a burden to your children. That's all that matters.